Hello and welcome. You've tuned into Business Lunch. I'm Nisha Poddar, and with me as always is my co-anchor Pavitra Parekh. So Pavitra, good note that market opened in the red today, but then look at the kind of recovery that it has seen during the session. In fact, at the moment, 0.6% up in trade. And from the low point of the day, if we really look at the Nifty 50 trajectory, which is trading closer to the 17,300 mark, though has given up that particular level just by a slight bit, it is about 190 points up from the low point of the day. So that is remarkable in terms of the buying action as well as the euphoria seen. Bank Nifty, again, I've been mentioning this over and over again, that whenever there is new euphoria and confidence in the market, keeping aside the inflation and interest rate concerns, it's the financials, the big banks like State Bank of India, ICICI Bank, Kotak Mahindra Bank, all really performing very well and adding that might to the market. But then market is not all about the key indices. It is the mid caps which are really underperforming in trade today, though have touched the flat line, looking comfortable now in the green. Advanced decline ratio impacted because of the mid cap universe, but on the other hand, not as bad as we can say. Pavitra.
Hi Nisha, good afternoon. So, it's really about the banks today, and even at the start of the session when we got the rate on the SGX, we were really expecting a big downtick. But look at the way the market is fared, and it is really all about that resilience that we have been talking about, all about the banks. So the bigger ones Nisha has already mentioned, but even if you take a look at some of the smaller names, the likes of Federal, IDFC First, some of those names will come up and they're also holding up really well. In addition, it is some of the auto stocks which are doing well. So take a look at Bajaj, Aisha. These ones are some of the top gainers on the Nifty as well. We'll talk more about that in a bit. On the downside, you have some of the metal stocks which are seeing some pressure. So the likes of Hindalco, JSW, few of those up on your screen. And then you also have the real estate pack. So Oberoi Realty in particular, which one is down after its earnings, but the rest of the stocks also seeing some pressure. So that's what's happening at the market level. But let's talk about individual names now. Bajaj Auto posted a largely inline set of second quarter numbers, while the market share rose to 20% from the 13% earlier. That's a key positive. So earlier today, we got in touch with Rakesh Sharma, who is Executive Director at Bajaj Auto, who, while remaining quite cautious, said that the company would continue on its current growth trajectory. So let's listen into that.
The reason for the export realizations to be better is a combination of two things. Primarily, it's a mix effect because the larger geography of Africa, which is generally the lower priced models which go there, that weight for that reduced. But on the other hand, our sales in our business in LATAM and ASEAN, the penetration or the market share and the mix of our higher end brands like Pulsar and Dominar, that improved. That aspect of the business will continue because we are having very good traction. In fact, all our new models are just about to be shipped, and they're going to be making an entry into LATAM and ASEAN. As you know, quarter two was a record smashing quarter for us. We have achieved our highest top line and our highest EBITDA in rupees crores ever. Of course, it was aided by, pipelining the stocks in the domestic market. But nevertheless, given all the stuff which was going around, it's a very, very delightful performance from our point of view. And going forward, our whole approach is to maintain both the top line and the bottom line and the profitability as we go forward. The demand in domestic is still muted. It is not negative, but it is very marginally positive during the festive.
All right, so that's the word coming in from the auto sector. Keep an eye on that. But Shree Cement is the next on our radar today. The stock is down more than 3%. It's trading lower after, remember, the second quarter results of this particular company has been below the street estimates. And in fact, on the EBITDA per ton level as well, it has been at a lower level. And earlier today, we spoke to the management on the kind of performance that they are expecting going forward. Take a listen.
Prices will be increasing when the natural demand will come. Right now, it should be after November 15 or so, the demand should be good. First half of the quarter is good monsoon. So that will have the good result in the year end, but not immediately. Immediately, the sales is little affected. Festive season is there. So we expect very good results from mid-November onwards. Right now, the costing also should decrease from December because the old stocks of coal are there with almost everyone. So I expect this quarter to be little better than the last quarter, but January, March should be a good quarter. In the first half, our volume growth is around 13%. So we expect 12 to 13% growth, but a little bit conservative. So I am saying 10%.
That is the word coming in from the Shree Cement management. But staying with earnings, we're now going to bring you a preview of what you should expect from the entire consumer durables pack. So Vahishta is standing by to take us through those numbers. Vahishta.
We are well 2 months into the festive season, and consumer durables is one sector that has its hopes pinned to. While the overall volumes have declined in July and August this year, the channel build-up towards the end of September is expected to support the growth for Q2 of FY23. The recent channel check suggests that inventories are now at normalized levels. Also, the premium categories continue to fare better versus the mass segments, which are grappling with high inflation and price increases. This means that demand from rural as well as entry-level segment remains subdued. Let's go through the segment-wise performances expectations. With Q2 of FY23 being an off-season, the AC volumes may not be significant in this quarter. Voltas revenue growth is expected at marginal 2% on a year-on-year basis, which is primarily led by higher realizations in unitary cooling products division. However, the margins could see a contraction of about 100 basis points. For Blue Star though, the market share improvement, which is led by distribution expansion and product portfolio revamp over the last year, would support the outperformance. The top line of Blue Star may jump by about 20%, with stable margins expected in Q2 of FY23. Now moving on to the small appliances segment. A slowdown in demand for fans along with continued weakness in pumps would result in sequential revenue decline for Crompton Greaves in its electrical consumer durables division, while the lighting revenues is expected to witness low single-digit growth. For other segments like lights and switches, some value growth can be expected. Havells India is expected to maintain its outperformance versus its peers with strong revenue growth momentum in switchgears, lighting, electrical consumer durables. But the EBITDA margins could see some contraction due to cost normalization and inflationary trends. For contract manufacturers like Dixon Technology, the revenue should be supported by volume growth in televisions and washing machines. The PLI-led scale-up in the mobile, telecom and IT segments would also add to the revenue growth. But for Amber Enterprises, the volumes would be impacted on account of high inventory levels with select brands. The lean period for cooling products is likely to weigh on Amber's top line. To summarize, the festive demand in October this year will be a key monitorable for the consumer durables industry, and the partial benefits of the cool down in commodity prices is likely to benefit margins, but the full effects will flow in only third quarter onwards.
All right, quite a detailed work and very, very exhaustive research there, Vahishta. With that, we'll slip into a short break and really digest all of that. But when we come back, there'll be an excerpt, an exclusive conversation with the Air India's new MD and CEO.
Hey guys, welcome back. You're still tuned into Business Lunch. Now, Air India has ambitious plans to triple its fleet size over the next 5 years and ramp up its capacity. In his first interview since being appointed MD and CEO at Air India, Campbell Wilson tells Shireen Bhan about the kind of capital infusion which will be required to achieve this target and also how the airline is planning on increasing its fleet. Listen in.
Well, we're not talking specifically numbers at the moment. We're talking about ambitions. We've publicly stated that we want to increase the fleet by about 3 times. We want to invest in products and systems and services that the customer experiences, but also that the employees need in order to provide the service we want to provide. It's going to require significant investment in aircraft, but not just aircraft. Really, so it's more about ambition rather than dollars at the moment, provided that we execute well and we are delivering the value and meeting the aspirations of our shareholder. I'm quite confident the capital will come.
But what would the ballpark number be, given the fleet expansion aspirations that you have, as well as everything else that you want to fix on the back end? And where is the capital going to come in from? Are you looking for capital outside of the promoters?
Well, again, I'm not going to put a number to the capital. I think you can do some back-of-the-envelope calculations. If you triple the fleet and multiply that by aircraft prices, you get a sense.
It would depend on who you're talking to and how hard of a bargain you're going to negotiate.
And trust me, we're negotiating a very hard bargain. But it's big numbers. But it's big numbers in the context of rebuilding an airline, a world-class airline, an airline with a global reach that represents and takes India to the world. So the numbers are big, but the ambition is big, and I think we've got the backing and the support to do it. With respect to how long it takes, look, it's going to take a while. This is going to be it's not a T20, this is a test match. And in a test match, you have different milestones. In the way to 100, you need to be patient, you need to be ambitious, you need to be sometimes a little bit lucky. Sometimes you'll score sixes, but mostly it's about graft application, patience, and scoring those ones and twos consistently over time to reach the objective.
So, since you're talking about scoring the ones and twos, let me pick up on that. There was a fleet expansion plan which started by the end of this year, and it continues, through the early part of next year as well. Is that on track? How many aircraft do you intend to have on board between December to the first quarter of next year?
So we started with a number of aircraft that were grounded, and over the course of the last 5 or 6 months, we've spent a lot of time working with Boeing and other OEMs to get these aircraft back into service. We've put 16 aircraft back into service. We've got another 12 to go. So that has enabled some expansion. The next immediate phase of expansion comes with leasing in of aircraft. We have 5 wide-body aircraft that we've already announced we're deploying to particularly North American markets, and then 25 narrow bodies that will come in the early part of next year in order to support the short-haul or domestic fleet. We're in conversations with other lessors to bring in more narrow bodies and wide bodies throughout the course of 2023. And of course, then we've got our OEM discussions with Boeing and Airbus and the engine manufacturers, which will then take the fleet expansion forward with aircraft that we will own and then carry forward from 2024 onwards. So we will increase the actual operating fleet from about 30, maybe nearly to 60 by the end part of 2023, and from 50 odd to probably 75 in the narrow body space.
And you can catch excerpts of this exclusive conversation all through the day only on CNBC TV. Welcome back. You're watching Business Lunch. A quick look at the market. In fact, market's getting stronger at this point, and it's the financials which is really lending that support coming in. 1.26% up in trade bank Nifty, and therefore Nifty 50 buoyed by some of the big financials like ICICI Bank being the top contributor, as well as largest Bank of India, State Bank of India, all putting a lot of might. 17,300 level reconquered by Nifty 50. Keep an eye out on Reliance Industries, the big boy, a big heavyweight. That's also adding a lot of might. Infosys and TCS not too behind. But in terms of losers, Larsen & Toubro is to be watched out for closely. And from the mid-cap universe, Trent has seen another fresh knockdown, so keep an eye out on that. Moving on then to some international development of the day, and Chinese President Xi Jinping, who is expected to be formally returning to power later this week, laid out his vision for the country at the Communist Party summit over the weekend. Now, in his speech, he paid tribute to the party's achievements under his rule and also promised to do more of the same, and an aggressive foreign policy and strong domestic control remain the core to his plans. In fact, CNBC's Sam Vadas gets us more details on this.
Here are some of the big takeaways from that speech that President Xi Jinping made yesterday. I'll start with warning against foreign interference in Taiwan, because, of course, this is something that's been a big focus, of course, for the markets, this rhetoric that we have heard. And, of course, President Xi Jinping talking about these peaceful efforts for reunification, but also reiterating that they would not renounce the use of force to bring the island back under their control. Of course, hailing China's zero COVID policy. This is something that investors have been talking about, this expectation that we may already see a shift perhaps in this strategy post-party Congress. This has certainly become a bit of a suggestion that this strategy is likely to stay, at least in the short term for now, vowing China's self-reliance in technology. Of course, this is another thing that is closely watched. We have seen a lot of sectors, of course, benefiting from this campaign to be more self-reliant in the area of AI, semiconductor chips, but also as part of these decarbonisation efforts with a lot of these green sectors as well. That is something, of course, we will be watching in terms of some of the sector reaction when it comes to some of their stocks. But of course, this is something we've been watching as part of this high quality growth that China, of course, is trying to shift to in terms of its economy. And development, he said, was the top priority. So certainly growth is very much key in terms of being front and centre as part of that speech that he made yesterday. Another thing, of course, investors are watching out for is who's going to be in charge in terms of the continuity and change of who will be in these top spots, who will be China's next premier. Of course, Premier Li Keqiang talking about stepping down, of course, at the next 5 years to make way for perhaps some younger blood. One person to, of course, watch is Wang Yang. He was sitting next to Premier Li Keqiang yesterday in the Great Hall of the People. Of course, he is part of the faction that peaked under Hu Jintao, perhaps not the favourite, but he has proven to be loyal to President Xi Jinping because he has been put in charge of Xinjiang and Tibet. So that would be very telling of a lot of President Xi Jinping's policies. Hu Chunhua is another one, also part of another faction, but Li Qiang is also one to watch as well, given that he has been the boss of Shanghai. He has been talked about as having a pretty good chance here. He may have blown that over the handling of the lockdown, but as far as what investors will be watching is how President Xi Jinping, through these men in the standing committee and who he puts as premier, will tell us about his consolidation of his grip on power and whether there will be a continuity of party policies over technocratic capabilities. Because, of course, we have Leakonomics, which had been front and centre, certainly in 2013, but that was, of course, sidelined to make way for Chic-onomics. So we are, of course, looking at people who will be potentially retiring as well. And a lot of this, of course, has got to do with the unofficial retirement age, 7 up, 8 down, which means 67, you can be promoted into the standing committee or the Politburo. 68, you must step down. And so we know Premier Li Keqiang is due to step down, Li Jianshu and Han Zhang also being of that age.
All right, Sam, thanks a lot for bringing us all of the key takeaways. But, you know, the main event that the market was watching out, the main comments the market was watching out for was whether there would be any kind of reiteration of the zero COVID policy or whether they would let that go. And that's really what has come through. There's been no sort of relaxation on that front. Now, remember the setup for this important address. China has been seeing slowing growth. In fact, it's currently at the slowest that we've seen in decades. So the world was watching that maybe in this situation, you know, they'd reprioritize growth. That has not come through. In fact, this morning, China has gone ahead and announced another lockdown. So 10 lakh people near an iPhone factory. This is one of their iPhone manufacturing hubs. So they've gone ahead and locked down that area as well because there was a virus flare-up. There was further no stimulus announced for the ailing property sector. This has been one of the key pain points, like we've been pointing out, for the Chinese markets. There's been no kind of stimulus there. And on the back of all of this, you know, analysts were anyway expecting that China's GDP growth is going to be quite muted. Just around 2.8 to 3% at best is what the analyst estimate suggests. This is for FY23. And this would also mean a 4-decade low for the GDP. In fact, the IMF data, which came through last week, that one, you know, sort of forecast that China's GDP will grow just 3.2% for this year. And to put this into context for you, this is down from the 8.1% that we saw in 2021. So, Nisha, that's really what's, you know, everything that's going far as the China picture goes.
That's right. All eyes will be on China being such a big economy, and how that really performs will have an overall impact across the globe and on world economies also. With that, it's a wrap from Pavitra, myself, and the entire team of Business Lunch. But Mid-Cap Radar is right here, ready. Don't go anywhere. Thanks so much.